Hi, I've heard it said that investing in property is simple, but it's not easy. Now, this isn't just a play on words. Let's face it, each year, hundreds of thousands of Australians turn to property investment as a way of developing financial freedom, or getting more choices in their life, or building a retirement nest egg. But very few achieve their goals. Hi, I'm Michael Yardney, and today I'd like to explain 8 surefire ways to lose money in property, and one great way to make property a successful, sound investment. Look at the facts. About 1 in 4 property investors sell their property within the first year of buying it, and almost half have sold up within 5 years. Of those who remain in the game, less than 10% own more than 2 properties, and less than 1 in 200 own 6 or more investment properties. Look, putting it bluntly, most property investors fail to reach their objectives. And my concern is that in the current environment, in this changing environment of our property markets, this is only going to get worse. But the good news is that there is a way to make property investment work. And I'm going to explain that in a moment. But first, let's look at the 8 surefire ways to lose money in property. And I'm going to explain them after I give you a quick ad for my new book, What Every Property Investor Needs to Know About Finance, Tax and the Law. This has been selling like hotcakes. It's already a bestseller. The first print run's run out and we've got a new print run, so we've got lots of stock of this great book which I've co-authored with finance strategist Rolf Schaefer, accountant Ed Chan and property lawyer Rob Verlander. And together we're going to show you, we're going to teach you how to build your own property investment business. Great book for you to get. Click on the link below and order your copy right now. Okay, back to what we were starting to talk about before. Currently our property markets, they're a confusing place, yet property investors are being bombarded with messages of easing money, which has led to what I see as a worrying trend where some investors are so keen to do something, in fact so keen to do anything, that they're heading for property investment disaster. You see, even if they don't have enough money, or haven't developed the discipline to save, or they've already borrowed to their limits, some potential investors feel they've just got to do something, and in their bid to get into the property market, they're now speculating rather than investing. Of course, I understand why they're keen to share in the profits others have achieved through property. But you know what? Sometimes the right thing to do for an investor is to do nothing. I've made more money by things I've said no to than things I've said yes to. That's because all my investments have been made as part of a planned strategy. Okay, so here are those 8 surefire ways to lose money in the current property markets. Number 1, buying off the plan. Look, sure, it sounds enticing. Buy today's value, settle on sell at a profit. Sounds good. But does it work? One of the big issues with buying off a plan is finance. You see, since loan approvals only last for around 3 months or so, obtaining formal pre-approval for an off-the-plan purchase is impossible. But the problem is, once the project is completed, some purchasers are going to be unable to obtain finance, and they're going to have to sell. Of course, others never intended to settle. They always were going to flip their property. They hoped to, I guess, make a profit. What this means is that when many projects are completed, there's going to be a group of, I guess, desperate vendors who are just going to lower their sale price to sell at whatever the market offers them. And even if you're one of those lucky ones who will be able to settle your purchase, the banks are only going to lend you against the prevailing market price of your property. That's not what you paid for it, it's what the lowest price achieved by those desperate vendors are. Now, add to this the fact that many banks often will only lend around 70% LVR in the postcodes where many of the big developments are, and suddenly what may have looked like a good investment starts to turn sour. Look, of course, there's lots of other reasons I'm not keen on off-the-plan purchases. Mainly things related to uncertainty about completion dates, the level of finishes, what the market condition is going to be like when you eventually take possession. This means you should be buying at a discount to make up for these unknowns. But currently, to get developments financed, to get developers off the ground, developers actually have to sell their products to you at a premium, not at a discount. And if that's not enough to turn you off buying off the plan, here's one last point. Almost all the developments that are sold off the plan are sold to investors. On the other hand, I like buying properties in buildings that have got a good deal of owner-occupiers, a reasonable proportion of those, because I just found that owner-occupiers tend to look after their buildings better. And you know what? This enhances the long-term capital growth. Okay, let's look at some other things that you shouldn't be doing in this market. Number two, house and land packages. I know some investors buy house and land packages because they've heard that land appreciates in value. But when you think about it, when you get the total cost of the house and land package, usually the land accounts for less than half the purchase price, giving these properties a very low land to asset ratio. Look, while they may be great places to bring up your family, in general, these new or outer suburbs are not good places to invest. Residents in these suburbs tend to have less disposable income than people who live in the more affluent, the middle ring suburbs. And you know what, at tougher times or when interest rates go up, they're going to suffer more. Remember, one of the big factors that enhances capital growth is scarcity. And that's something that's missing in these new outer suburbs where you get the house and land packages. Many properties tend to look the same, and there's always another estate just across the road, new houses being built there. So I'd avoid house and land. Another reason I would avoid investing in these areas is the demographics. You know, they just don't attract the same demand from a diversity of different tenants as the inner and middle ring suburbs do. The third strategy I'd avoid in this market is buy, renovate and sell a property. Look, I'm all for adding value through renovations, but you can't buy a property, do some minimal work and sell at a profit. You know, there's things like stamp duty, buying and selling costs and tax, and they eat away at your profit. On the other hand, buy, renovate and hold is a great investment strategy at the moment. The next strategy to avoid is positive cash flow properties. If you've been following my blogs, you're going to realise I believe the best way to financial independence through property is to accumulate assets, to build a big asset base. And in Australia, properties with high capital growth usually have low rental returns. Now sure, owning this sort of property requires more discipline, but you know what? You can't save your way to wealth with a few dollars a week positive cash flow. The next strategy to avoid is options. It's another surefire way to lose money, following some of these creative schemes currently promoted by property spruikers. People with little or no money are tempted by the prospect of, bypassing the banks. They even, want to bypass learning the discipline of saving. They're happy to hear promoters' suggestions they can control millions of dollars worth of property with none of their own money by using an option. Now, there's nothing new about these schemes, and if history repeats itself, the promoters of today will become very rich while the students will learn a very expensive lesson. The next thing to be wary of is rental guarantees. This is where the seller or developer guarantees a certain rental for a period of time. Now this panders to inexperienced investors' concerns about vacancies. But these guarantees come at a cost. Don't be misled. They're factored into the purchase price you're paying. In fact, you're paying the developer up front for the rent he's going to repay you over the years. The next area to avoid is regional properties. Look, I admit some regional areas have exhibited better growth than a few underperforming suburban areas. But on the whole, capital city properties have outperformed other types of properties in the long term. Since two important drivers of capital growth include strong population growth and a diverse, strong local economy, I only invest in capital cities. And the last area I'd like you to avoid is investing in mining towns. Look, yes, I know we're going through the mother of all resources booms, and mining towns are going to grow in the future. But if history repeats itself, and you know what, it usually does, the property market in these towns will be driven by speculative investors. While there's likely to be some short-term booms, property prices in these towns, they tend to be very volatile. If you don't believe me, just try selling a property in one of these towns today and see if you find any buyers. Well, if these methods don't work, what does? There's one proven, time-tested method that's made average Australians very, very wealthy. If you want to grow your own significant property portfolio, you need to own properties that provide you with wealth-producing rates of return. This means buying a well-located property below its intrinsic value in an area that's outperformed the averages over the long term, and a property, one to which you can add some value. You can create some capital growth. Now, this could be through negotiating well, through renovations, through refurbishments, through redevelopment. Then over time, what you do is you borrow against the property's capital appreciation and grow your portfolio one property at a time. That's what a small group of investors, those who've achieved financial independence through property, have always done. Now, I'm going to keep you up to date with how to do this in future property updates. Between now and then, I'm going to keep you updated on how to take advantage of the changes happening in our property markets. It's also probably appropriate to remind you that in changing times like we're experiencing, no one can help you quite like the independent investment strategists at Metropole. Remember, the multi-award winning team of property investment strategists at Metropole have no properties to sell, so their advice is unbiased, it's independent. If you want to find out a bit more about what's happening in your local market and what our research suggests in store for us, join us at a free property briefing in Melbourne, Sydney or Brisbane, or with our associates in Perth. Just click on the link below and find out more and reserve your place for these free briefings. Also, as so much is happening in our property markets nowadays, I'm actually keeping you updated with my blog almost every day. So just click on the Michael's blog link up at the top there and subscribe to it. It's a very different subscription to my regular fortnightly newsletter. It gives you short daily updates. Look forward to sending you my next update in 2 weeks. In the meantime, have a great week. Make it a great week. This is Michael Yeo.